Alright guys, welcome back to another module on Da Vinci Program. So today we're going to go over fib calibrations and how to use Fibonacci, when to use Fibonacci, and more or less what Fibonacci is about. I mean, what is it about really? It's just a tool, but as all tools, as like all tools, you've got to understand how to use it and when to use it and what it really means. So let's just go over the bare facts, guys. So before we go into any of the uses of it or how to use it or how to implement it, I just want to talk to you guys about what it actually is. And to do that, I want to find a good area price, and this looks like it might be a good one. Alright guys, so what is it? Alright, so the Fibonacci tool, guys, is more or less a range concept tool. Alright, what I mean by that is, what it is essentially doing is it's showing you the different levels inside the range, or inside any particular range, guys. And as you know from the previous video, the range concept video, the range is any area between its significant high or significant low. All right. So in this situation, we do have a range here that I'm drawing from that low to that high, and I'm doing this because I want you to show you how the Fibonacci tool works and how I use it and what it more or less means. So this is just showing you the areas in between any significant high or any significant low, guys, alright? And what it is essentially showing you is it's showing you where the equilibrium is, okay? So 50% is equilibrium. That is the midpoint of the range, guys. And that's a very important concept as well. I mean, I'll probably do a separate video on it, but the equilibrium is more or less the midpoint of any range, alright, guys? And it's very important because that midpoint is a pivotal point inside any range. It doesn't matter if it's on a daily chart or it's on a 15-minute chart or it's on a 5-minute, 1 minute, hourly. It doesn't really matter, guys. All right, it's the same concept that we're talking about here. So that midpoint range, guys, the 50% level, is extremely important because it shows you what program price is inside the range. And what I mean by program is it shows you, is price in discount or is it in premium? And it's simple as that, guys, alright? And what I mean by discount and premium is that when we want to buy or when we want to sell, we only want to be buying or selling in the discount area of the range. Alright, guys? Only in the discount area. We don't want to be buying at premium, and we don't want to be selling at premium. And the reason for that is because if you're selling at premium, that means you are selling near a low point. And you don't really want to be selling low. You want to be selling as close to the last structure high as you can be. And you want to be buying as close to the last structure low as you can be. And the reason for that, guys, is because that is what's going to give you the best entries, the best risk to reward on your trades. And also, it's just gonna allow you to be able to frame your trades in a better way. All right, you don't want to be buying at the top of the range near a high. You don't want to be doing that. You want to be buying as deep into the range, as close to the low area of the range as you can be. All right, guys, and that's just going to give you better entries, man, and it's going to make you a lot more comfortable in your trades, and it's going to work a lot better with the style of trading that I'm trying to teach you guys. Alright, but essentially what this is showing you is it's showing you, number one, where the midpoint of the range is. So in this situation, guys, we have a range from this low to this high. Alright, guys, and this is more or less showing us that, okay, from that range low to that range high, we have two significant swing points. We also have intermediate high between that high and that low, and we also have a midpoint also. Alright, guys, and the midpoint is very poignant because, as we went before, it is a pivotal area. Alright, guys, and I want you just to look at the price action around this midpoint, around the equilibrium level. So as you can see, price rose above it, broke above EQ, came out of the discount range, boom, we saw it rise up, form the structure high, and what did price do? Drop back down into the midpoint of the range, dipped below that level, and rose back up. Dropped back down again, contracted back into the range, dipped into equilibrium level, rose up again. Then what did it do? It broke below it, retested it, and then it broke below it and continued lower, guys. And I want you just to understand that when you are trading inside the range, guys, a big part of understanding where price is going to go, or where the price is going to continue to break above and take out a higher or a lower range, is knowing where the midpoint is. Okay, guys? So in this situation, you know, understanding where the price is going to continue lower and take out that low, you want to know where this midpoint is, because in this situation you can see, guys, price did not really, it stayed above the midpoint of the range, and it's only when it broke above it, broke below it and retested it right there, that we saw price take out that low of the range. So look at the 50% level, look at the EQ level as more or less, it's more or less like a support or resistance level. That's what it really is inside the range. When we're using range concepts, that is more or less like a support and a resistance level by itself. And what it will allow you to know is if price is above that level, then it's most likely we're going to see higher prices, or we're going to see price take out the higher range, or at least get close to it. Or if price is broken below it, then we're most likely going to see it seek liquidity on the bottom side of the market. All right, guys, and it's really as simple as that. But this is the first use that I have for it. It's understanding where the equilibrium level is, and that by itself is going to allow me, when I'm in range trading or range, more or less ranging conditions, right? It's going to allow me to know when to seek liquidity on either side of the market. And then obviously once I know that, I can then couple that with, you know, order blocks, breakers, market structure breaks, that kind of stuff, which we'll go into later. But it's understanding this basic formation that's going to allow you to know when to take certain trades, when to look for certain entries, and that's what's going to allow you to almost be profitable and just have a better understanding of what the market's doing at any given time. So in this situation, guys, that's the first thing I want you to grasp, is the EQ level. And I mean, go into your charts after you watch this, go and understand, mark out your range high to your range low, or vice versa, and look to see the price action around equilibrium, because a lot of the time you will see various touches or various pullbacks inside that level, or back to that level, and that's going to show you, you know, where price is within range. This is also going to show you how and when to get entries and when to look for liquidity on either side. All right, guys. Now, I mean, apart from that, the main purpose of this is to obviously understand the discount and the premium, which I was talking about earlier. And the reason for that is because it's going to tell, the Fibonacci is more or less going to show you when the best time is to sell inside a range, when price is either trending bearishly or trending bearishly. So let's say we have price trending bearishly, right? Let's say we're talking about this whole area of price right here. I'm just going to draw out for you. So in this instance, price did break out that range and we saw lower prices, all right? So the first thing I want to be doing is I want to be using the Fibonacci in these situations to understand when it's the best time to sell and when it's the best time to buy. But in this situation, we want to know when it's the best time to sell price, you know, because we don't want to be selling price at any given point. You know, we don't want to be selling here, and because as you can see, price, you know, you could have got an entry there, you could have sold there, but price, you know, more or less would have risen up, taken you out, stopped you out, and then it would have probably stopped you out. If it hadn't stopped you out there, it would have probably stopped you out there. So you want to be buying as close to this retracement level as you can be. All right, guys, you want to be buying a retracement. And the way retracements work is that the retracement is basically buying price when it's at the best possible price you can get it at. You want to be buying low and selling high. So what I mean by that, guys, is if we draw a Fibonacci from a swing high right here to a swing low, what we want to see is, we want to see price first of all to get above EQ. All right, guys, and for the same reason I talked about before, we want to see price get above that level, because that indicates to us that price is now in the discount area of the range. Okay, guys, once price gets above EQ, it's now discount if we are selling in this situation. So if we're selling, guys, you want to draw your Fibonacci level from a high to a low, and that will give you the right OT levels here. And we'll go over how to calibrate these on your Fib, guys, but for now I just want you to understand that when you are selling, you want to pull your Fibonacci from your high to your low, and this will give you a Fibonacci retracement and show you the area of price that you want to be looking for a sell position in. So in this situation, guys, the reason why I'll be looking to sell this is because we saw price break a structure low right here. So this was our first indication, guys, that price wanted to seek lower prices. We saw price literally properly break through a structure low. All right, we saw candles close below that low. So that indicates that price wants to go lower, or it wants to see lower prices. So in this situation, what we do is we wait for price to pull back into range. So we wait for price to print a lower low. Okay, guys, that's the first thing we do. Once price takes out that low, we want it to print a lower low, and in this case, that was the lower low that it printed. And then it pulled back into what range? From the most recent swing high to the lower low that it's just printed, or to the most recent swing low that it's just printed. Okay, guys. So in this situation, what we do is we use the Fibonacci tool to give us a framework of where we should be selling. Okay, guys, because we only want to be buying price when price is retracing. So what I do is I draw my Fibonacci level, and as you can see, price came into one of our optimal trade entries. Okay, guys. So these are the optimal trade entries. These are the levels that you want to be buying price, or you want to be selling or buying price within. This is the optimal, it's literally the optimal trade entry. Alright, guys, so these are the levels you want to be buying or selling price in. So in this situation, when we saw price make a structure low, a new structure low, break past the previous structure low, and it formed a retracement, that is the level we want to be buying at or selling at. So this just gives us a structure to know when to sell. Alright, guys, it lets us know, okay, we've made a new structure low now. Where's the next structure high going to be formed? Most likely it's going to be formed inside this area. Alright, guys, so, and I won't take trades alone, just using this concept. I mean, you can do it. I will combine it with breakers, and I'll combine it with blocks. But this just gives me, this is the first bit of confidence that I need if I'm taking this type of OTE setup. Okay, guys, this type of optimal trade setup, this is the first type of setup, or this is the first type of condition that I need to see in the market. So as you can see, guys, we formed a new lower high inside that range, and in this situation we saw it create lower prices, price retraced again, and then boom, we saw a new structure low being made there. Alright, guys, so let me just get off the chart. So this technique, guys, is, it's a simple retracement technique. It's just understanding range concepts. It's understanding where price is within a range, and it's understanding, where the equilibrium is and where the discount range is. So that would have been the first opportunity to sell if you wanted to look for lower prices. However, if we go and have a further look, once price made that structure, high, or that new lower structure high, it then created another price leg which we could have drawn a Fibonacci level off. Alright, guys, and as you can see here again, we see another opportunity to get short. Why? Because price gave us a retracement back into this range between that swing high and that swing low, and also again price is above EQ. Alright, guys, so price is above the fair value point, and it's now into discount territory. So as you can see, price came into our first OTE level, and then boom, what do we see? We saw it sell at a sell-off, and then form to go on to create lower prices. Alright, guys, so this is how I'll be using this. I mean, if we are using breakers, we won't necessarily use this type of setup, because this setup is particularly for optimal trade entries. Is particularly for a retracement setup. A breaker setup is a bit different, because a breaker is more, a breaker above a high or a low, and it's just a retest of that low or that high. But in that situation, we're going to be using a candle instead of the low. However, in this situation, guys, in OTE setups, what we want to see is we want to see a retracement back into the range, another leg to form another price leg down, or another price leg up. So one thing that I do, guys, to strengthen this is that I use blocks. I don't use breakers, alright? But in particular, I'll use blocks. And the reason for that is because once we have this range marked out, what it allows us to do is it then allows us to say, okay, we've got one bit of confidence now, but if we really want to pinpoint an area to sell from, where are we going to pinpoint an area? How are we going to do that? Now in this situation, we do have a block here. Alright, guys, it's a very, very small block, but it's a block nonetheless, alright? So it's the last up candle before that down move. Alright guys, so in this situation we saw price rise back up into this range. It came into our OT area, our sweet spot area as well, which is a very good area for price to come into. In fact, that's the best optimal trade entry that we can more or less get. And it also came into a block. Alright guys, so that is two pieces of confluences now. So you can see how first you map out the range and you use the Fibonacci to give you your structure, to give you the area that you want to be looking at, and then you can further pinpoint it with your blocks. And as you can see guys, price came to the block, did not close above the EQ. I did wick above it, but it didn't close above it. And then what did we see? We saw it then go on to sell off. And from that high to that low is a good, that's 190. That's 190 pips. That's a good opportunity to sell. However, in these situations, guys, what I want to be seeing with OT setups is when we get our retracement, I want to see price take out the previous structure low. Alright guys, so this is how I trade this setup. What I look for is I look for a market structure break to indicate that price wants to go lower. Okay, and a market structure break is more or less just a break of a structure low or a structure high. And in this situation, guys, it's breaking that structure low. So once we see that structure low break and we see a pullback inside this defined range, then what I want to see is for price to come into our resistance level in this situation, come into our area, optimal trade area, and then for it to go and take out the previous structure low. Alright guys, and as you can see in this situation, the first test we didn't get it, but we did get another retracement, and price eventually did come and take out that structure low. Alright guys, and with me, I'm very modest with these targets, so what I'll do is I will generally wait for price to retrace, to find a retracement first. I'll wait for price to come and find resistance at these levels. Alright, and then what I'll do is I would target the next area of liquidity, guys. So it's the same thing, like this is how you can use range concepts to also trade trending markets, guys. It's just understanding where liquidity is. So we mark out that structure high and that structure low. If you've got a retracement, right, like that, back into that range, and you sold from that point there, then you're using your same range concepts to find a targeting level, guys. So all you're going to really be doing is, once you find support, so resistance there, you just target the next area of liquidity, guys. And in this situation, that'll be that next structure low. Why? Because people that want to go short of the market, retail traders that want to go short, they're going to have their sell stops below that structure low. Alright guys, because a lot of people are breakout traders, so they won't understand, or they won't use range concepts. They will simply just say, okay, once price breaks a low, then that's when I want to sell. They won't use this technique here, where we're trying to get the best price to sell at and the most secure price to sell at, rather than trying to sell breakouts, right guys? You don't want to be doing that. You don't want to be doing this at all, because as you can see, price won't always break through at a level. What it will do is that it might break through, it'll have a false break, run that level there, because the banks know that there's going to be stops at that level. They'll run that level there and they'll just pull price back into the range and you get stopped out. So the best thing to do, guys, is to use these concepts and understand where liquidity is, understand how to use the Fibonacci to frame your trades. And guys, and we use this technique once price has broken a structure high or a structure low, guys. We only use this technique in that situation. If we don't see price break a structure high, then we don't really use that technique as such. Alright guys, so I know some of you are going to say, okay, so why do you use it here? The reason for that, guys, is because I had more than one confluence here. So what price did is, as much as it didn't take out that structure low there, the market maker just built liquidity there. But what did happen is that we did get a retracement. And what did price retrace into? It retraced into a block there again. So in other words, it retraced into a resistance level, and then it looked for lower prices. Okay guys, boom, and then we saw lower prices from there on. So yes, when you're first starting, guys, I want you just to understand this concept on a very methodical base, on a very methodical level. Once price has broken the structure low and it retraces, then I want you to use this technique. Alright, so once you see it start retracing and you probably have bigger targets for it, for example, let's say, because for me this would have been the bigger target, and this is where your range techniques come into play, guys. Price is always within a range. You just have to understand which range it is actually in at any given point, and the higher time frames you go up, the bigger the range is going to be. So in this situation, guys, this is what we're looking at. That's the area price that we're looking at. So this is the range that we have marked out on the daily now. We have the range from that structure low to that structure high. Okay, guys? And of course, we're going to have liquidity on either side of the range, aren't we? So why would I sell? Why am I selling at this point? Okay, and I'll explain to you guys. The reason why I'm selling at that point, we're looking for a sell position, is because we broke through this structure low. Same technique, guys. Okay, on the daily chart, we broke and we closed below that structure low there. Alright, pull back slightly into the range, barely. We more or less just pulled back into that block there, which is now a breaker. And then what did we get? A break below that low there. Okay, so in this situation, guys, the reason why I'm targeting that low is because price has already shown an indication on the daily chart that it wants to go lower, and it's broken through a low. And then what it did again, it broke through that structure low again, indicating that it wanted further lower prices. So in this situation, when price is bearish like this on the daily chart, then I just say, okay, where is the next area of liquidity? Boom, it would be that low. Why is it going to reach for that low? It will reach for that low because that is the next area of liquidity, and also price is heavily bearish at this point. It's already shown that it wants to break through that low, and it's broken through that subsequent low as well, and it's come to retest that area or that daily block that we have marked out here, and also a 4-hour block that we have marked out there. So in this situation, guys, I'll be targeting that low, and that is why I would be bearish this market, because this is what I'm framing on, guys. I'm framing it on that low to that high, and that would be the low that I'm targeting. So we go back down to the 4-hour chart, guys. That would be why I would be taking a short position there again, because on the high time frame, on the daily chart above it, I'm already targeting a low that is below where price currently is at the moment. So I already know that price has a willingness to go lower, and it's already shown us that it wants to break through that low. So for me, this is just another opportunity to get short again. However, when you first start trading, guys, you must just keep it simple. Wait for price to break through a low, wait for a retracement, and then target the next structure low. And in this situation, that would have occurred. You could have taken profit there, or if you wanted to hold it longer, you could have taken profit at that structure low on the daily chart right here. And as you can see, price retested our daily block there. That's our first entry. That'd have been a second entry if we wanted to take it. And price took out that structure low that we marked out there on the 4-hour chart. And then what it did, it went also to take out that structure low on the daily chart. And boom, we see an expansion down, taking liquidity from that low. Okay, guys? But this is all framed on Fibonacci levels. It's all framed on range concepts, guys. Okay, we're not doing anything different here. All we're doing is we're combining our range concepts, and we're now using that with Fibonacci retracement levels, and we're now using that with market structure breaks. So this is how I'm framing trades, guys. Okay, this is how I'm framing trades. It's very, very simple. We just have our levels marked out. Our range levels are swing high and are swing low on the higher time frames. We break it down on the lower time frames. We wait for price to break a structure low. In other words, we wait for price to break the market structure at the time. We wait for a retracement using our Fibonacci levels. We wait for price to pull back into our secondary levels, okay, which is our blocks. That would indicate to us and pinpoint to us where price is going to find resistance inside of that defined range already. And then we would target the next area of liquidity, which would be below that range. Okay, guys, so this is how you use Fibonacci levels in terms of understanding where to get entries from, and also understanding where price is going to seek liquidity next. And yeah, guys, so it's a very, very simple thing. You know, Fibonacci is more or less just understanding where the range high and the low is, and understanding the points of discount and the points of premium, so that you understand the best time to sell and the best time to buy. Alright guys, so I'm going to show you one more example, and this will be on the buying side of the range. So now this is an opportunity to buy or get long, and it's the same concepts we're using here again, guys. Okay, it's no different, and I want to just show you this example because it's probably a better example to use. So it's a similar situation we have here, guys. Okay, now after we had that big down move, price went on to make a lower high there, then it went on to again break the market structure. Okay, we broke that low again, right here. God, I hate this platform sometimes. We broke that low and we retraced back into the area again for a sell position. And what we did is that we found lower prices and we again formed a new structure low right here. Okay guys, so what are we doing? We're mapping out the ranges. That's what we're doing, guys. It's the same range techniques again. Boom. We've got a high there, we've got a lower low here, price broke through structure. What happened here? Okay, we made a lower high there in comparison to that high, and then price ran that high, but what did it do? It closed below it, which just indicates that again it's a stop run. Price went to create a high low there, a lower low there. So price remained, what did it do? It remained inside that new structure low to that structure high. So what was it doing? It was building liquidity below these lows. And then what did it do? A lower high there again, inside this range that we got marked out. And then we saw an expansion to the downside, and we formed a new lower low. Now, in this situation, what did we get? We got a break above that structure high, and then what did we get here? So price formed an intermediate low right here, guys. Okay, so when we are drawing our Fibonacci levels, what we want to do is we want to start understanding first of all, we want to be drawing it from the most obvious structure lows and the most obvious structure highs. However, what you want to see is when you want to buy, or when you want to get involved in the market, when you want to go long in the market, it doesn't always benefit you to draw it from the most obvious structure highs and most obvious structure lows. This is where you can start to use your own discretion when drawing Fibonacci's and what ranges you use. And in this situation, if we drew a Fibonacci from that structure low to that structure high, what would have happened is that price didn't come down to our discount area. Okay, it didn't come down to our discount area to buy from. And why is that? Well, sometimes what we do is that we don't use the right, sometimes we don't use the right ranges, or the range that we're using isn't the correct range to be using for a long entry on these positions. And what I mean by that, guys, is that this is when you have to use, this is why you should always use more than one piece of confluence with your trades. So in this situation, the Fibonacci level enough, using that structure low to that structure high, that wouldn't have given you an entry. Why? Because we did not frame it on blocks. We didn't frame it using our next bit of confluence, which is order blocks. So in this situation, guys, I would have used that structure low instead. So yes, I understand that it isn't the most obvious significant swing point. However, if you want to get a long entry in this position after price breaks that structure high, what you want to see is you want to frame your price. You want to see what is the next area of support that price most likely is going to drop down to. And in this situation, guys, the next area of support would have been that block rather than that low here. Okay, guys? Because that block is a much more obvious area of support. Okay, it's a lot more obvious than that low. I mean, yes, price could have pulled back into one of these blocks, but this is a very, very obvious block. It's very beefy. It's very obvious. And also, we do have a low that was made here. Okay, because we have two higher lows above it. This one is barely high, but also we see that low that is higher to that one there. And it is framed on a block, guys. The key thing is that we are framing this on this order block right here. All right, we are framing it on that block. That is the key thing here, guys. Okay, so that is why I wouldn't have used that structure low, because this block is what we are framing it on. This is where price is going to be reaching for. So this is the range that you want to be using, from that new structure high to that new structure low. And that is where you draw your Fibonacci from, not that low. Alright guys? Now, you could draw it from that low, just to show you the wider perspective, or the wider range that price is in. And as we were saying before, if price can use the equilibrium level as support, and in situations it does actually use it as support. However, what you really want to be focused on is the blocks, because this is what price is going to pivot on, guys. Price won't necessarily just pivot off Fibonacci levels. It's going to pivot off support levels and liquidity levels, alright? So either highs and lows, or blocks and breakers. Alright guys, so in this situation, that's why when price returned to that block, we saw an expansion to the upside to take out liquidity at that high. And then this is when the Fibonacci would have given us an entry. And as you can see, the sweet price came down to the sweet spot, also came down to that block and whipped off the 79 retracement OTE area, and then we saw higher prices. Alright guys, so this is where you guys have to go through the charts yourself to understand this continuity things better. I can understand, I know which levels to put my fib from, 95% of the time, just because I have the experience now, and I've gone through the charts, and I've had quite a few years practicing this stuff. But when you're first starting this, you want to just make sure that you understand the framework, and you want to make sure that you are doing things methodically. Alright guys, that's the main thing. As long as you do things methodically, and you're saying, okay, we have a structure low there, we have a structure high that's just been formed, price should retrace back into our OTE level. Keep it very simple, guys, alright? Just follow the framework, and then obviously once you see price do certain things, you build your experience within price, you build your experience trading, and that experience is going to tell you when to use ranges, or when to use Fibonacci levels, and what range to pull it from also. So in this situation, guys, you could have got a long entry from here. If we delete that and we look for another entry, where could we go on an entry, guys? And this is when we start looking for blocks alongside our Fibonacci levels. So that high has now been taken out. Price has now created a new structure high, guys. Boom. Where would we draw our Fibonacci level from? Would we draw it from this structure low to that structure high? Or would we draw it from that structure low to that structure high? Now guys, this is where you just want to base it off. You want to use basically a mixture of blocks and Fibonacci levels for these situations, guys. So in this situation, we didn't even get a return to our Fibonacci level, but we did get a return to a block. Alright guys, and this is the key thing. We want to frame our Fibonacci levels off blocks, because what it will do is it will give us two confluences. But the most important thing to focus on really is the block, really. That's the most important thing. The Fibonacci level will just give us an area of price to work in, but the block is what price is going to be moving off, guys. And that's what you want to focus on. But you want to still draw your Fibonacci levels to show you which block you should be using. Okay, guys? So this is what it becomes. First of all, you want to start using Fibonacci, start to understand the ranges, to understand premium discount. But then as you graduate and you get experience, you want to start using it just to pick out poignant blocks that price most likely will come into. And that's where it starts getting more interesting, because then you understand how price works, what support and resistance it's going to use, and then framing that within the range, and framing that within range concepts. Alright guys, so after we see that, we see price come in, we see it meander a bit, and then what it does, it expands, it takes out the previous high, and again we form a new structure high. Process repeats itself again. Whatever we draw it from, I would have drawn it from that structure high to that structure, from that structure low to that structure high. Why? Because we have a very, very small block here. Okay. And price comes into that, forms a new structure high, takes out liquidity from the previous high that's been formed, drops back into the defined range, and it also drops down into that block. Alright guys, and don't think just because some blocks are small they are less powerful. It's funnier because usually the smallest blocks are the most powerful ones. They're just less obvious. And that's why when you draw your Fibonacci level in this situation, your Fibonacci level would have been really useful, because it would have shown you that's the block you want to focus on. That's the area you want to focus on, because it's inside, it's a deep retracement. It's supported by the sweet spot level, and it's supported by the range concept. And then what happens, guys, we see it trickle up, then it expands, takes out that previous high. And if we're just targeting the high, guys, this is what I usually do. I usually put my stop below the low, and I will literally just target the structure high. And then boom, what do we get? An expansion up, and we see price take out that structure high. Alright guys, so this is how you basically use Fibonacci to understand when to buy, when to sell, what a premium and discount is, and where price is inside the range. Alright guys, so I hope it was helpful, and PM me if you need any help. As usual, go to the group and we'll be in contact.